Almost every country on Earth owes money. The United States owes over $34 trillion. Japan owes more than twice the size of its entire economy. Even fast-growing nations carry mountains of sovereign debt. Look at the numbers long enough, and a strange question starts to appear. If every country is in debt, who exactly is the creditor? Who's sitting on the other side of this global IOU? It sounds like a simple question, but the answer reveals something strange about how the modern financial system actually works. Because countries don't borrow money the way you or I do. When governments need money, they don't go to a bank and ask for a loan. They issue bonds. A government bond is basically a promise. You lend money today, and the government promises to repay it later with interest. That bond then enters the global financial system. And here's where things get interesting. Some of those bonds are bought by other countries. For example, China and Japan hold large amounts of U.S. Treasury bonds. Governments often invest their foreign reserves this way. But that's only a small part of the picture. A huge share of government debt is owned by institutions, pension funds, insurance companies, investment funds, and banks. In other words, your retirement savings might be lending money to governments you've never even visited. And then there are central banks. During financial crises, central banks often buy massive quantities of government bonds. In the years after the 2008 crisis and again during the pandemic, central banks purchased trillions of dollars of sovereign debt to stabilize markets, which leads to a strange loop. Governments issue debt, financial institutions buy it, central banks sometimes buy it from them. Money circulates through the system like a web of promises. So when we say countries are in debt, it doesn't mean they owe some mysterious global lender hiding behind the curtain. They mostly owe the system itself. Citizens, institutions, banks, and central banks are all connected through this giant network of debt and assets. One country's liability becomes someone else's investment, which sounds stable, at least on paper, but it creates an interesting dependency. The entire structure works only as long as investors believe governments will keep paying their debts. That belief keeps bonds valuable, keeps borrowing costs low, and allows countries to keep financing their economies. Lose that confidence, and the system starts to shake. Because if investors ever stopped trusting government debt, the global financial system wouldn't just lose an asset, it would lose one of its most important foundations. And that raises a question that economists quietly debate but rarely answer out loud. If the world's financial system is built on governments endlessly rolling over debt, what happens the day enough lenders decide they'd rather not lend anymore?